Thank you very much, Alex. Good afternoon. As Alex said, I'm part of the Financial Services faculty in ICAEW in London. I am the insurance lead in the faculty. So I'll be speaking about IFRS 17, but mainly highlighting the issues and the recent amendments of the standard that was already issued. IFRS 17 was issued by the IASB in May 2017. It provides principle-based requirements that aim to improve the comparability of the measurement and presentation of insurance contracts across entities. It requires insurance contracts to be measured by using a probability-weighted discounted cash flow model. It also includes best estimates and an adjustment for non-discounted cash flow, non-financial risk calculated for groups of similar contracts. It relies heavily on actuarial modeling techniques and the quality of the underlying data. Insurance contracts combine features of both a financial instrument and a service contract. In addition, many insurance contracts generate cash flows with substantial variability over a long period. To provide useful information about these features, IFRS 17 combines current measurement of future cash flows with the recognition of profit over a period that services are provided. It presents insurance service results separately from insurance finance income and expenses. And it requires an entity to make accounting policy choices of whether to recognize all insurance finance income and expenses in the P&L or in the other comprehensive income in the OCI. The key principles in IFRS 17 are, sorry, could I just please have the slide? Yeah, that one. Great, thank you. As I said, the key principles in IFRS 17 are that an entity identifies insurance contracts as contracts under which the entity accepts a significant insurance risk from another party, that is the policyholder, by agreeing to compensate the policyholder if a specified uncertain future event adversely affects the policyholder. The entity separates specified embedded derivatives, direct investment components, and distinct performance obligations from insurance contracts. It divides the contracts into groups that it will recognize and measure. It recognizes and measures groups of insurance contracts at a risk-adjusted present value of future cash flows and at an amount representing the unearned profit in the group of insurance contracts. That is the contractual service margin, or CSM. Under IFRS 17, the entity recognizes the profit from a group of insurance contracts over the period the entity provides the insurance cover. If a group of contracts is or becomes loss-making, the loss is recognized immediately. The entity presents separately insurance revenue, insurance service expenses, and insurance finance income and expenses. And it discloses information to enable the users of the financial statements to assess the effect of the contracts within the scope of IFRS 17 have on the financial position, financial performance, and the cash flows of the entity. IFRS 17 also contains an optional simplified measurement approach or premium allocation approach for simpler contracts. These are, for example, motor, household, and travel insurance contracts. IFRS 17 is needed to address many inadequacies in the wide range of insurance accounting practices used in applying IFRS 4, and significant activities are already underway to implement IFRS 17. Since it was issued, the board has proactively been working to support insurance and others in the transition to the standard, including through establishing the Transition Resource Group in the UK and providing education materials. As part of that process, it has sought to understand any concerns and implementation challenges that insurance have identified while implementing the standard. Could I please have the next slide? Thank you. The board considered those concerns and challenges and concluded that the potential costs of proposing targeted amendments to IFRS 17 could be justified if those amendments would provide a meaningful support to entities implementing the standard. In the board's view, such amendments would be justified if they wouldn't change the fundamental principles of the standard, resulting in a significant loss of useful information for users of the financial statements, and they would avoid unduly disrupting the implementation efforts already underway or cause an undue delay in the effective date of IFRS 17. While listening to the concerns, the board decided that the following amendments were proposed in response to concerns. You can see the list on the slide, but I just read them out. So these ones were the deferral of the effective date, additional scope exclusions for some loans and credit cards, allocation of acquisition costs to expected contract renewals, attribution of profit to service related to investment activities, extension of the risk mitigation option, reduced accounting mismatches for reinsurance, simplified balance sheet presentation, and some additional transition reliefs. Now we're going to go through in more detail of these main concerns, of insurers' main concerns, the board's decisions, and the effect of these decisions on insurers. Let's start with the deferral of the effective date. Limitations of the availability of internal and third-party experts, particularly actuaries and IT system providers, means that entities need a lot longer time for the implementation than they originally expected. There was also significant uncertainty surrounding the potential amendments of the standard, which also affected planning and budgeting for the implementation. In the exposure draft issued and consulted on last year, a one-year deferral of the effective date was recommended, but subsequently, especially after the COVID-19 pandemic has started, this was extended to 1st of January 2023. This is coming together with the expiry date for the temporary exemption from IFRS 9. Most of the insurance industry welcomes this deferral. The implementation requires significant challenges to systems and processes, as well as considerable increase in the required granularity of data. The additional time also removes the uncertainty that the endorsement process wouldn't complete for the 2022 start date. It will also allow for global consistency around the transition date. Let's look at the additional scope exclusions. For loans, a loan that transfers significant insurance risk is an insurance contract that contains both a loan and an insurance component. When up until now applying IFRS 4, some entities separate the loans in such contracts and apply IFRS 9 to them. However, IFRS 17 won't allow for this practice to continue. This is called the unbundling. And as it was originally issued, it would have had to be applied to the loan contract in its entirety. Just to make it a little bit easier to understand, these contracts could be, for example, equity release mortgages or student loan contracts where the repayment is tied to students making a minimum amount of salary. Following the amendments, the IASB permits to apply either IFRS 17 or IFRS 9 to insurance contracts that provide insurance coverage only for the settlement of the policyholder's obligation created by the contract. The choice would have to be made on a portfolio-by-portfolio basis, using the IFRS 17 definition of a portfolio. Some credit card contracts provide insurance coverage free or for a set fee. Entities that today account for these credit card contracts applying IFRS 9 would need to change the accounting once IFRS 17 becomes effective, very shortly after the costs of complying with IFRS 9. Following the decisions on the amendments, IFRS 17 would not apply to credit card contracts for which the fee charged to the customer doesn't reflect an assessment of the insurance risk associated with that individual customer. Instead, other relevant IFRS standards, for example, IFRS 9, 15, or IAS 37 would apply. Allocation of acquisition costs to expected contract renewals. Currently, commissions paid unconditionally on contracts that have been issued cannot be allocated to expected contract renewals. In some cases, these commissions may exceed the premium for the initially written contracts, causing the contracts to be onerous, viewed as being inconsistent with the economic substance of these transactions. According to the IASB's proposed amendments, part of the insurance acquisition cash flows are to be allocated to expected contract renewals. Cash flows would be recognized as an asset until the entity recognizes the actual contract renewals. Recoverability of the asset will have to be assessed at each period. The board expects that by allocating portion of the commissions to renewals, it would be easier for insurers to explain to investors why the commissions paid on new insurance contracts are higher than the premiums. This is a change or an amendment that many general insurers will welcome. The accounting for products that are priced to renew will reflect the economic substance of these transactions. Without this amendment, some of these contracts might be considered to be onerous, when in reality they are not. In practice, this means that fewer contracts would be loss-making, and assets for acquisition costs, such as commissions, would last longer and would be subject to an impairment test. Of course, new disclosures would be required to provide more information on these acquisition costs. Attribution of profit to service related to investment activities. For certain insurance contracts, these are the ones with direct participation features. For example, these could be deferred annuity contracts. Contractual service margin is recognized over the insurance coverage period, reflecting the pattern just of the insurance activity. When determining this pattern or the period over which the CSM is recognized, other services, such as investment service, are not considered. For some contracts, however, the insurance coverage period differs from the period in which the policyholder gets return on the investment component. The proposed amendment would recognize the CSM reflecting the pattern of both the insurance coverage and the investment service, if a specified criteria are met, indicating that an investment service actually exists. This means that in practice, the timing of profit recognition would change for some long-term contracts. This will also have to be described in new disclosures. The proposed amendment was welcomed particularly by life insurers. The profit recognition pattern would better reflect the timing of provision of these services related to investment activities. In practice, however, identifying separate coverage units for investment and insurance services will be very difficult. An appropriate pattern of profit recognition will have to be found that fairly reflects the service provided to policyholders, and it doesn't put undue operational complexity on insurers. Other decisions will have to be made on levels of aggregation, discount rates, and other factors before properly tested outcomes can help make the final decisions. Extension of the risk mitigation option. Derivatives or reinsurance contracts may be used to mitigate financial risk arising from insurance contracts with direct participation features. When derivatives are used, the risk mitigation option permits an entity to recognize the effect of some or all of the changes in financial risk on insurance contracts with direct participation features in the P&L, when they would otherwise have to adjust the contractual service margin. In December 2019, the board decided that the risk mitigation option would be extended to apply to entities that purchase reinsurance contracts to mitigate the financial risks. This is in addition to the risk mitigation option when derivatives are used to mitigate the risk. This extension will actually provide additional relief for many insurers with insurance contracts with direct participation features. If applied, this option means that the effect of applicable changes in financial risk not arising from the underlying items can be recognized immediately in the P&L. The application of this option may highlight some ineffectiveness in some entities' mitigation practices. Reduced accounting mismatches for reinsurance. Following the original intentions of IFRS 17, losses on onerous insurance contracts are recognized immediately. When those losses are covered by reinsurance contracts, any corresponding gains are to be recognized over the whole coverage period. As a result, accounting mismatches may arise. Following the proposed amendments, an entity that recognizes losses on onerous insurance contracts at initial recognition would also recognize a gain on reinsurance contracts held. This is permitted to the extent that the reinsurance contracts were recognized before or at the same time as the losses recognized on the underlying direct insurance contract. The board also amended the proposed calculation of the amount of reinsurance gain because of the extension of the scope. This calculation will still require judgment. The extension of the scope and this amendment was very welcome by insurers because it takes away the need to define proportionate as it was originally proposed in the exposure draft about the amendments. There are, however, still very significant challenges with reinsurance. In particular, the need to have the reinsurance in place before or at the same time as the direct underlying contract. This is actually not current market practice, so insurers will need to review the approach to placing reinsurance on big deals and look at ways of getting this in place concurrently with the direct contracts. There are some other serious issues or significant issues with reinsurance. For example, contract boundaries, which do not always align with the underlying direct insurance contracts. Eligibility for the variable fee approach. Even when the direct underlying contracts are eligible for the variable fee approach in IFRS 17, reinsurance contracts are not eligible. The premium allocation approach eligibility. Again, it needs to be carefully considered whether the reinsurance contract is eligible even when the underlying contract is. And finally, data. Not only the accounting for reinsurance is complicated, but ensuring that all the data is available is also very challenging. Simplified balance sheet presentation. IFRS 17 originally required groups of insurance contracts to be separately presented in an asset and liability position. To do this, insurers would need better IT system integrations, resulting in a significant implementation cost. Following the amendments, the board permitted insurers to present insurance assets and liabilities separately in the balance sheet using portfolios of insurance contracts instead of groups of insurance contracts. This is a really significant help for all insurers. And some additional transitional reliefs. Use of estimates. Stakeholders during the presentation period consultation period, stakeholders raised concerns that the specified transition reliefs in IFRS 17 implied that entities would not be able to make estimates in determining transition amounts. The basis for conclusion supporting the exposure draft explains that the board actually expects entities to make estimates to determine transition amounts. Business combinations. Liabilities for claim settlement are treated as liabilities for remaining coverage in the contracts if the contracts were acquired in a business combination, and as a liability for incurred claims if the contracts were originally issued by the entity. Some entities use a single system to manage all liabilities for claim settlement and find it difficult to obtain the required data to separate and measure liabilities for claim settlement in two different ways. At transition, following the amendments, it is now permitted that an entity accounts for liabilities for claim settlement acquired in a business combination as a liability for incurred claims as well, if it doesn't have reasonable and supportable information to apply a retrospective approach. Some transitional reliefs relating to the risk mitigation option. One relating to the transition date. Previously, the risk mitigation option could not be applied for periods before the date of the initial application of IFRS 17. In other words, before the beginning of the annual reporting period in which IFRS 17 first applied. This prohibition would have affected comparative information for the period immediately before of the date of the initial application. Following the amendments, now an entity is permitted to apply the risk mitigation option from the date of transition to IFRS 17. In other words, the beginning of the annual reporting period immediately before the date of the initial application, if the entity designates the risk mitigation relationships to which it will apply the risk mitigation option no later than that date. This amendment will significantly help with the comparative information. The risk mitigation option and the fair value approach. If risk mitigation activities were in place before the date of the initial application of IFRS 17, some stakeholders think that equity on transition and revenue recognized in future periods might be distorted. The board proposes to permit the use of the fair value approach to transition. If an entity chooses to apply the risk mitigation option prospectively from the transition date, and it has used derivatives or reinsurance to mitigate financial risk before the date of the transition. If an insurer uses the fair value transition option this way, then it would measure groups of insurance contracts using current estimates of financial assumptions. Any derivative or reinsurance would be measured at fair value, meaning that the equity on transaction would reflect both the previous changes in fulfillment cash flows due to the changes in financial assumptions and the changes in the fair value of derivatives providing the risk mitigation. In addition to approving the transitional reliefs proposed in the exposure draft, the board also decided to provide additional ones. These include the identification of the investment contracts with discretionary participation features and the identification of whether reinsurance contracts were acquired before the underlying contracts. Many insurers were asking for more general changes in the consultation on the exposure draft to make it possible to apply the modified retrospective approach, but the board decided not to make any changes. However, all these additional transitional reliefs the board proposed were actually helpful, but we need to remind ourselves the modified retrospective approach remains very challenging, and there are some circumstances when it can't be applied at all. The main issue is that the alternative fair value approach, that is alternative to the modified retrospective approach, is a totally different basis of measurement, as it is a fully prospective approach. Insurers are still working through the implications of these. Now, as you can see on the slides, I listed some areas where amendments were not proposed, even though a lot of respondents to the consultation in the exposure draft were asking for these amendments. The most significant one is definitely the annual cohorts. The requirement to use annual cohorts as part of the process of accounting for the CSM has been a subject for very much debate since IFRS 17 was first issued. In their response to the exposure draft, some stakeholders advocated for the removal or the amendment of the annual cohort requirement for some or all insurance contracts. However, in February this year, the board decided to confirm again this requirement. And they have provided some reasoning for it. When producing a standard, the board considered different approaches for the aggregation of insurance contracts into different groups and portfolios. One of these included segregation based on similar profitability. It concluded that the best approach to group insurance contracts is where insurance contracts are broadly grouped based on expected profitability at initial recognition, including the separation of any contracts that are onerous at initial recognition. To this, they added the annual cohort requirement, meaning that all contracts in a group must have been issued within the same 12-month period. The board decided that the cohort approach is essential to ensure that aggregation is not so great as to render profit measures meaningless. Without it, there would be a commingling of different generational contracts with different profitability, which would obscure the presentation of the effects of different pricing decisions at different times. And this would avoid accountability. And without it, the recognition of losses from onerous contracts would be delayed potentially for years. So they concluded that the absence of annual cohorts might lead to highly imprudent accounting practices because of the failure to recognize profits and losses on contracts not in the appropriate accounting periods. For the UK industry, this is actually not such a great issue, but we see significant challenges in continental Europe, especially in Italy and France. Another area where the board didn't propose any amendments were the paragraph B107, where the standard talks about level of assessment for the variable fee approach eligibility. The board confirmed its proposed minor amendments to paragraph B107 to require that eligibility for the variable fee approach is assessed at a contract-by-contract level as opposed to a group of contracts level. The board actually regarded this amendment as an editorial correction. However, in their discussions, they recognized that there have been significant differences in interpretation of this requirement by the industry. This can actually have a significant effect on insurers' business, but it will depend on the nature of products. Another area where there were no amendments proposed were contracts that change in nature over time. This is actually a highly debated issue, especially for life insurers in the UK. It relates to contracts that change in nature over time, or where it seems that different accounting models should apply during the coverage period. An example of such contract is one with a saving phase with profit sharing that provides a policyholder with an option to subsequently convert the actual account balance into an annuity with a guaranteed rate. So it is an insurance contract. The board considered concerns raised by some respondents regarding the perceived accounting mismatches. For example, if the variable fee approach is applied to these contracts when they are in the payout phase. However, the board decided not to make any amendments to IFRS 17 in this area, as different solutions were favored by different respondents, and some of these solutions would have changed the fundamental aspects of IFRS 17. So, as I have been talking about the amendments to IFRS 17 compared to what it was originally issued, this will give some relief to most insurers in implementing the new standard. But it will be still a very complex and significant undertaking. It will require substantial effort, new and upgraded data, systems, processes, and controls. It is vital that insurers make good use of the extra time, the delay of 2 years. Even with this extra time, many insurers will need to step up their implementation process efforts to reach the finish line with systems and processes tested and results understood by management and investors. To successfully implement IFRS 17, insurers will need the full support of their board of directors. To ensure that the transition is successful, there are a few key areas that management needs to consider. Project planning and management, the key decisions, change management process, design, build and testing of controls and models, and the IT infrastructure. Managing the transition. Controls and monitoring need to be in place to provide a timely and high-quality implementation. Business processes, systems, and data. The best source of data need to be identified. Systems, processes, and controls will need to be in place. Financial reporting and controls need to be designed, documented, and tested. Accounting policies, judgments, and estimates. The key policies and choices, transition options, interpretations, estimates, and judgments need to be decided and documented and tested. Resources and training. Insurers will need multidisciplinary teams working together from finance, IT, actuarial, operations. Business impact. Expected impact on strategy, business planning, pricing, products, and distribution will have to be all considered. Stakeholder communication. Business and financial performance will need to be well understood and communicated to investors. Disclosures. More detailed requirements will have to be complied with, and comparisons with peers will have to be performed. And finally, group and local applications. Both statutory and group requirements will both need to be met. In addition to consider these areas with boards and management, it is helpful to discuss plans and concerns with the external auditors as well. This can only be helpful during the transition phase and once the standard is fully operational. Could I please have the next slide? Thank you. While we have been getting ready for the implementation of IFRS 17, we need to remind ourselves that IFRS 17 is actually not endorsed in all jurisdictions yet. Although the IASB sets IFRS, it has no powers to direct or permit the use of IFRS. This is a decision of the legislative in each jurisdiction. The process of making a decision on the use of a new IFRS or any amendment is called the endorsement. The European Financial Reporting Advisory Group, EFRAG, the advisor to the European Commission on IFRS endorsement, has commenced its activities relating to IFRS 17 back at the end of 2017. It has conducted case studies with preparers and outreach with users of financial statements to get a better understanding of the impact of the adoption of IFRS 17 in Europe. IFRS is planning to finalize its endorsement advice in December 2020. Following this, the European Commission has to make its decision, which includes time for the European Parliament to scrutinize the endorsement regulation. This process will take at least 12 months. Given the EU timetable, this means that the UK will independently have to decide on the endorsement of IFRS 17. This is because since following the Brexit vote back in 2016, the transition period before leaving will end on the 31st of December 2020. Therefore, the UK will not be subject to EU endorsement. And finally, let's speak about some effects the new standard will have on the industry. First, some practical considerations. As we can see, IFRS 17 will be a significant change for insurers, perhaps the most substantial change in the working life of many listeners. Even though it would be tempting to think that the 2-year delay gives time for pause and reevaluation, insurers really don't have that luxury. With the consequences of the COVID-19 pandemic as well, most project work in insurance companies have been suspended. Therefore, the extra time provided is being used up by the delay. Many companies are actually considering where to invest their resources to make the most of the extra time. Understandably, the primary focus so far has been on methodology and CSM-related technical and system decisions. This is now expanding to cover some of the related areas: investment in actuarial analysis tools, and closer alignment of accounting and actuarial capabilities, both in terms of processes, systems, and teams. One area actually that very few are tackling in the moment, but it warrants more attention, is the financial planning and analysis capability. IFRS 17 introduces significant complexities that need to be addressed in budgeting and forecasting methodology, processes, and systems. Insurers would be well advised to carry out extensive analysis to understand the impact of IFRS 17 under various scenarios and identify potential levers for managing these impacts, for example, through changes to reinsurance practices. The next step is then to engage with the users of your financial reporting as well, for example, your investors and analysts, to start demonstrating and discussing how to arrive at the underlying performance of your business from published IFRS 17 results. The insurance industry has been working together, especially in the UK, and sharing information to work towards a consistent interpretation of the requirements. There is no expectation on publishing any financial information until the latter part of 2022. Insurers are still building and testing their new systems. There are discussions around VFA eligibility, benchmarking, and KPIs, for example. European insurers do have the advantage, though, of having to comply with the Solvency II directive. The lack of this means that in Asia, a broader range of metrics are being used generally, and there is less consistency in the industry. For all of the listeners, it would be probably very helpful to engage in local discussions around interpretation and implementation. Thank you very much. I think on the further slides, you can see some more information about our faculty. And I also included a couple of helpful links where you can see more information on the amendments. This is one of the agenda papers for the IASB's March 2020 meeting. And also I highly recommend you have a look at the GPPC papers on IFRS 17 implementation. The GPPC is a group of the 6 largest accounting firms, and they provide considerations for boards and audit committees. Thank you very much for listening.